Andy's medical issue.
All right, now that the fancy AI told us to have a meeting, I'm gonna call this meeting to order. The VEHI board, Tuesday, March 18th at 3:02 p.m. I'm going to share the agenda and we can, oh. Let me know if you can see it.
Yes.
Yeah, okay, thank you. I can't see everybody. I'm on a single screen, so I'll be at a disadvantage today. But all right, so first order of business is to review and adopt the agenda. Any notes or proposals to amend the agenda? Hold on. And please give me a verbal since I can't see everybody. Seeing none, do I have a motion to approve the agenda?
So moved.
Lance, and second from Lisa. All in favor, say aye.
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 Opposed? Motion passes unanimously. Move on to public comment. Any members of the public present who wish to make a comment? Seeing none, we'll move on to item number 3, approving the January 28th and February 25th meeting minutes. Any notes or comments from board members? All right. Seeing none, can I have a motion to approve both sets of minutes?
So moved.
Motion made
As
by
written.
Lee.
As written.
Yes.
Second by, oh yes, thank you. Second,
Second, Cheryl.
thank you, Cheryl. All in favor, say aye.
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 Opposed, seeing none. No. So the motion passes unanimously. All right, next up, and I will say we do have a chock full agenda, so I am gonna try and keep to the minutes scheduled that we all agreed to. All right, so Chris, the floor is yours for October, December financials. Oh, we can't hear you.
Just realized that. I was going to say, knowing that we have a tight agenda, I'm not going to spend a lot of time on the financials. There's, you're all used to seeing the financial statements. So I'm just going to give you a really quick overview and then let me know if you have any questions. Health, as I had alluded to, we are at a net loss as of 12/31 of $13 million. And this compares to a loss of $7.5 million at this same time last year. So, and as a reminder, we ended up with about a $15 million loss last year. So it is concerning to see that at this point, we're even worse off than we were a year ago at this same time. Humira is going to be coming off to the generic. So hopefully that will help us spot, but we've got a lot of other things we're butting up against. Dental is running just fine. We've got a small operating loss, but we were budgeting an even larger operating loss there, so not a problem there. The investments as of 12/31 are still holding. As I'm sure you all know, the market is going crazy right now, but as of 12/31, we still had positive market change of just over $1 million and interest and dividends of $727,000. I can tell you that has eroded a little bit as of January 31st, but not a lot. We lost about 41,000 through February. So investments are still holding okay through the end of February. January, we did see some relief on the claims with the deductibles resetting. So basically, January's bottom line looks like a $6.9 million loss. That seems really positive, and that's a nice number to see coming away from a $13 million loss, but it is very temporary. Just to let you know, I haven't finished February yet, but I can tell you that the last 3 weeks of claims runs have been in the $8-9 million range a week. So it went right back up, shot back up really quickly this year. Some years I'm used to seeing the January, February, March timeframe, all those 3 months being less pressure. This year, it was about 6 weeks of less pressure. And then the claims are going right back up. So definitely a concern that we're all aware of. Basically, budget to actual, we're in line with our budget except for claims. Revenues in line and other expenses are in line. It's just the claims that are out of control. So does anybody have any questions on the financials? All righty. So I think that's all I have to say on them. Unless someone has questions.
All right. Thank you, Chris. Very
Sure.
efficient. Not great
Hey.
news, but very
No.
efficient.
Yes.
Always look on the bright side. Your next report is after the third quarter, right?
Yes. Yes.
Okay.
But our next agenda item, I will kind of elaborate. We've got some more updates, so that's why I didn't want to spend too long on 12/31.
Yep. So why don't we go move on to the next?
Do we want a
agenda.
motion to approve?
Thank you, Suzanne.
See, I am paying attention.
Maybe not approve, at least
May I
accept.
have a motion to approve? Wait, who was the first? Who was it? Who was the motion?
I didn't.
Motion?
I move to approve the January, oh, I'm sorry, the October, December financials from Chris.
Second? Cheryl, thank you. Any discussion? Seeing none, all those approve, say aye.
Aye.
Opposed? Motion passes unanimously. Thank you. Thank you, Chris.
Sure.
All right, let's move on to the next agenda item, which is, as you said, related. Discuss our net position projections for 25 and 26.
Yes. So DFR had reached out after they received our 12/31 financial statements, and they were asking for a reforecast and an update on projections. So we went back to Blue Cross Blue Shield and had the actuaries readjust the and relook at FY25 and FY26. They were able to bring in this reforecast another 6 months worth of data based on their last forecast. So it gives a better picture. They were able to bring in data through 12/31 of 2024 into their forecasting. So to get a better picture on trending. So that reforecast, the last reforecast that we had for health for FY25 said we were going to add about 5.5 million to net position for this year. Now, based on what we've been seeing in the financials, I've been reporting all along that I didn't think that that was going to be the case based on what I was seeing and as the actuals were developing. Their new reforecast is showing that they expect a $6.3 million loss before investments, which would be estimated maybe a 5.6 loss after. It's really hard to know what investments are going to do right now. They're so up in the air. I don't know what that's going to do it to us as of 6:30. I mean, you're going to take a snapshot on that one day, and that's what it's going to be. So that's hard to know. But you know, it's about a $12.5 million swing from their last projection, because they expected we were going to gain 5.5, and now we're going to lose 6.3 on the operating side with the new claims estimates in there. That would leave us at 7.5% for our net position ratio. That puts us in our policy in the 6 to 9% range, which we talked about that being a real possibility when we set the rates for FY26, unfortunately. If you play that out in FY26, they're still projecting a small gain of 3 million for FY26, which would leave us at 7.9% at the end of FY26. But that is going out quite a ways. So those estimates may change at that time. Who knows? So on our policy, we're in that 6 to 9% range, which means that we need to have a written plan presented to the board and in place by November 15th. Hopefully we don't end lower than 6%. Then we have to submit to DFR the written plan as well for approval. So this is the range that we're looking at being in as of the end of this fiscal year. But we will need a written plan, at least between the board and management, by November 15th, which comes right into play with our rate setting. I mean, we need to be, we're going to be thinking about that in conjunction with our rate setting. So I think that they sort of develop at the same time as to how we're going to react. Any questions on that piece? And then I'll get into our meeting that we had with DFR yesterday.
I just have I'll go ahead, Cheryl.
So I guess that my question is, so in the policy, it says strategies to address this. So that would be my question. What are the strategies that we would have to consider to address it?
Okay. So that was one of the things that DFR was asking yesterday. I mean, they weren't asking for an official written plan, but they wanted to meet with us. And they were looking for a recast narrative, updated projections, which we gave from Blue Cross Blue Shield. And then they wanted us to discuss our plan going forward and what we would do if there was further deterioration of net assets. John, did you have something to add at this point before I move on?
I was just going to say that in that plan that Mike had on the screen, it says at 9%, the board has to come up, we have to come up with a plan to go to the board. And then below 6%, we have to submit that plan to DFR. I can guarantee you, they're going to want to see the plan before we're at 6%.
Yes. Yes, because they're already asked.
Right.
So
there's really not
even though
much
this-
difference there.
Right. So basically our meeting with DFR, we started with Matt and Allison were there from Blue Cross Blue Shield attending the meeting. They presented their findings. Matt spoke from the last look that he did. He said that it is actually the driver is mostly utilization that's taking us from the positive 5.5 to the negative 6.3 now. That the pharmacy trend had an estimate in there of 15%. It's now trending at 20%. The utilization trend is also worse than the filing. So that, so basically what he's saying is that the cost trend that they had built into their assumptions for FY25 were probably in line as far as their expense cost trend. It's more the usage that is above and beyond what they were expecting. There is some acuity as well coming along, meaning the high cost cases are trending higher than we expected. And what they're seeing is in line with their book of business and other nationwide trends. So VEHI again is not unique in this space. So we started with that. And then this is what I will go down through and I'll tell you exactly what I presented and what we presented to DFR. That the board was very engaged, very aware of the concerns, that we have some potential options that we're exploring, which include plan design, looking at centers of excellence, teledoc options, and because lots of times there aren't primary care, you can't get into your primary care office, so you end up in the ER. So are there more teledoc options to relieve the cost of ER visits? That we are researching, not making any changes now, but we are researching changes to the GLP-1 eligibility requirements for weight loss drugs. We have 180% increase in that 1RX in 1 year. And DFR actually specifically asked about GLP-1 drugs as well. They brought that up. So that's definitely on everyone's radar.
Chris,
I think I remember seeing one of them. Yeah, go ahead, Bobby Joe.
Sorry, can you just identify the cost that's associated with that 180%? Because it's not a $20 drug.
No, I think it was like, I'm trying to remember which, I've looked at a lot of different numbers on this one and different timeframes, but I think it's around like $14 million a year that we're spending on GLP-1 drugs.
Yeah.
And about half of that is diabetes, people with actual diagnoses, and half of that is just people who want to lose weight. So, or I shouldn't say that. People who do not have that diagnosis. I shouldn't say that. It's making an assumption. Shouldn't assume. But it is a big deal. And it's going to go up and up and up. And just my personal opinion on GLP-1 drugs, I watch TV, and I don't know if you've seen it, but there are so many advertising now promoting it. Weight Watchers is on the bandwagon. There's all these other companies. They're like, oh, call us up. We'll check your insurance. We'll get this right through. So it's really being pumped from a lot of avenues. And so I think that curve is going to continue to rise. We spoke about as a more of a I just want to make sure that they knew that we always continue to monitor our investments and our investment vehicles to make sure that we're being fiduciarily sound in that arena as well. Not a lot to be done there, but I did want to mention that to DFR. So those were the kind of the things that I highlighted that maybe we could think about doing, and maybe there's more, and I want us to think, but these were the ones that I felt like we had been talking about. Then I also went on to say that we are hopeful that the state initiatives in conjunction with the Green Mountain Care Board will provide relief to decrease hospital spending. We're also watching the PDAB, the Prescription Drug Affordability Board progress. We hope that that will provide some relief in the future. And then I sort of ended with, as far as, because DFR is interested in VEHI's financial stability. And I basically communicated that in our member agreement, we do have the right ability to assess mid-year should we have to, that we'd want to avoid that if at all possible. And if we had to make an adjustment, it would be the next rate setting cycle. But we do have that ability in our member agreement if something really went sideways to maintain the stability, financial stability of VEHI. So that was basically the context of the call. I don't know if others. Yeah. Go ahead.
The mid-year, that means assessing the school districts for a little extra cash to replenish our net position.
Yeah, or to pay claims. I mean, I don't think we would go there very quietly. I would hate to ever see us assess mid-year. I mean, I would much rather see us raise our rates for FY27 by some crazy percentage than to assess mid-year. School budgets can't handle that. Towns can't handle that. Where is that money going to come from? So, that's worst case scenario.
Okay.
And I don't think we're there. But I think what we may be facing is a large increase for FY27. That's between us. I didn't say that to DFR, that definitive.
All right. Questions?
Does anybody else have anything that was on the call to add to that?
I have a question.
Yes.
You used the word usage, so I'm gonna want to know what that is. Is it like usage, the number of visits people take, or is it just strictly a dollar amount that you're talking about? When you say usage, what does that
Okay,
mean?
maybe I meant to say utilization, probably. But I'm talking about the number of visits or the number of infusions in these high level prescription drug area. But yes, our utilization means not the cost, but the actual number of visits and the actual amount of specialty visits and hospital stays and things like that.
Do we have data that breaks those two down, like the specialty visits and the, sort of regular run of the mill, going for a checkup, going in to get your knee looked at because it's sore, whatever. Do we have data that breaks those out, or is it just all one big lump of visits?
Well, when we do our rate filing, they break things out quite a bit.
In the narrative that Blue Cross just did, wasn't it? In the narrative they did with the update?
I don't remember how much they broke it out in that narrative. I know that it's more comprehensive on the rate renewals, and this was an interim update, so I'm not sure.
Have we seen that? Is that something that's been sent to us? Or no?
The narrative,
No.
yes,
Oh, the narrative was?
I believe so.
Cross Blue Shield narrative, that's in a packet or something, or, you just sent it
Um,
to us, or?
I think it was in the appointment. I'll find it and I'll send it out. If we
Okay,
haven't.
okay, thank you.
Mark?
Yeah, just to Lance's question first, in Blue Cross's narrative, and I don't have it in front of me, so this may be inaccurate. They tend to talk about utilization broadly in respect to trend, professional visits, as Chris noted, pharmacy trend, hospitalization trend. They don't usually give us in those narratives, you had 1,200 primary care visits, you had 3,400 specialty visits. When we have our actuarial review with Blue Cross annually, we take a deeper dive into those numbers. Sometimes the categories are very specific about what kinds of care and how much. Other times it's more of a percentage of total utilization. And we do know that around 4% of our care goes to primary care visits. Or 4% of our spend, excuse me, goes to about primary care visits, 12% for specialty office visits, 55% to hospital, 55% inpatient, outpatient, and roughly 20% for RX. We actually have an analytics review coming up, I think in May. We can certainly ask Blue Cross to stratify that data a little differently than they normally do. But we still know that the biggest cost drivers and the biggest factors for our premiums are what's happening at the hospitals with inpatient and outpatient services, and also RX. And I want to just accent a point Chris made earlier. Utilization is certainly about the number of visits, but it's also, and she mentioned this, the acuity of care, the intensity of care. So sometimes you can have a higher utilization trend, not necessarily because there's more visits, but because the people getting care are seeing more doctors or getting more services. The same patient getting more doctors, seeing more doctors, getting more services. That acuity intensity factor is always baked into these trend numbers as well.
Is utilization measured in dollars? Or is it just a general term to describe what we're seeing?
Well,
Really,
utilization,
utilization, I think they're trying to take that away from dollars. I mean, you can equate it to dollars, but when they're looking at it actuarial, I think they're trying to look at
Volume.
I think that's
volume.
right. Yeah. I mean, very broadly, big picture, utilization is the product of two things, right? It's the volume of services. And again, acuity is baked into that, multiplied by the cost.
Right.
And then what we have to do as a team is to try to parse the effects of those two things in terms of how we plan, do benefit design, et cetera.
Right.
Yeah, well, that was
other-
my question is when we're talking about this, are we talking about the dollar amount? And that is what is getting higher, or is it the actual, I mean, are people actually going to use services more often, more times? Or is it that the cost of these services has gone up so much that even if they were not going to the doctor more, if it was basically the same amount of usage, but it cost more, that's what's making it trend higher? That's what my question was.
Trend, yes. So trend shows both utilization and cost. So it's both. How many services did I have and how much did those cost? How much did the services cost? And then when you talk about utilization, that's talking about volume of claims, not dollars of claims, but how many times there's a visit. But it's absolutely both. The costs are very high and people are using more services. It's both of those things that are playing into this. So for example, the GLP-1s we were talking about, those have been consistently running in the 800 to 1,200 range per month per patient. And that didn't change over the year. It's still a ridiculous amount. It's still a very expensive drug. It didn't change, but the volume doubled over the course of 23 to 24. So that's, so both of those things are playing into the trend.
Yeah, that's a really good example. And conversely, and we saw this over years with a drug like Humira, we didn't necessarily see a great jump in volume from quarter to quarter or year to year with Humira, but we saw a big jump in cost. So if your population didn't go up a lot, but the per member per month cost of that drug did, then we took a hit on that as well. And Humira was under a patent for 20 years, so there's not much we could do about it. I think as we approach this analytics review with Blue Cross, I think we should probably perhaps ask for a little more finer or granular detail than we have in past years. Because again, big picture, and Mike jokingly referred to this before we got started, 5% still drives, 5% of our claimants still drive better than 50% of our costs. Top 1% still drive 30% roughly of our costs, et cetera. So understanding better what's going on within those percentages, I think that would be a helpful conversation to have with Blue Cross at this stage.
And I think it's a good conversation to have as a board.
Yes.
Because remember, what we're talking about is, our net position is lower than our threshold. And what we've ended up talking about is the reasons why. And I think the board really needs to understand that for a lot of different discussions.
I agree.
So I'll put that on our backlog for agenda items for future meetings, especially after that analysis from Blue Cross Blue Shield. But I want to encourage the board to go back to Chris's presentation, and that we are going to have to come up with a plan to address this. So further questions or comments about the net position?
All right, I have a question.
Yeah, go
I'm
ahead,
just
Lisa.
I'm not entirely, I think you've been talking about this, but the hospitalization and the RX, is it the usage that amounts to 75%?
Hospital and RX combined amounts
Is-
to about 75% of our total claims cost.
Okay. And so that's not the cost, not the number of people access or the number of
Correct.
access.
That's
Okay.
correct. Like I was looking at some numbers
Okay.
today around hospital utilization, and in 2023, we had like 7,300 outpatient visits at UVMMC. Right. So
Okay.
that's an actual number of people who got care at UVMMC. That 75% figure is, you look at our total claims cost, 75% of that's attributable to hospital services and RX.
So addressing the hospital issue is a pretty, as well as RX, is pretty significant in
I
terms
think so.
of
Yeah,
dealing
I would
with
agree with
our,
that.
I mean, those are the primary,
Yeah.
okay, I wanted
Yeah.
to make sure I was on the right page. Okay.
Yeah, I
So
think
just
you were.
to,
You're
Just a-
singing Mark's song for him. Yes.
so
Um,
just one more comment. I just want to
yeah.
kind of talk about cost and utilization in another perspective. So basically, Blue Cross Blue Shield and all of us know that we've got this cost curve coming up, okay? And they baked a cost inflationary assumption into their FY25 and FY26 projections. So when they gave me that re-projection of that we were going to gain now 5.6 million, okay, they had a certain cost in there and then a certain usage, a certain utilization built in, two different assumptions. So what I was trying to highlight is that from that last time till now, what has changed is that their cost assumption they put in is still accurate. They didn't blow the scale on that one. They knew about what they were going to be paying, and that was correct. It's the utilization, it's the number of visits that has changed since that last look, and bringing that extra 6 months in is showing. So that's sort of where their actuarial projections went awry from the last look, was not on cost, it was on usage and number of visits.
All right, we got 4 more minutes. Andrew?
I might be dropping a bomb here, but after reading through some of that stuff that got sent earlier and everything, and knowing this, do we actually know why Vermont has that is the highest? Like, is it everything? Like, is it the hospitalization and the RX? Because everyone else has hospitalization and RX. So why are we so much higher than everybody else? Maybe that's a dumb question and I should know.
I don't think it's a dumb question at all. I can probably answer it more thoroughly when we get to the Vermont Healthcare 911 portion, if that's okay. I think that's the data you were alluding to, Andy. Okay.
So my question to you, Chris, around the net position is, when does the board need to act? When does VEHI need to act?
Well, I think that, what we owe in an official document is that we need to have something firmed up by 11:50. Okay. But
Wait, say
I
that again?
think November 15th is when we have to have the official firm document in place. But certainly, that's not going to happen overnight. So I think that this may be a list that I threw out here. I think that as a board, we need to think about, are there things we want to put on this list? Do we still agree with this whole list? I mean, I think these were all appropriate to communicate to DFR. But I mean, I would think we should start looking right away at, plan design options, some of these other things, the sooner the better. It's going to be November before we know it. And also we have to set our rates in October. So we need to figure out what we're going to do and what we can affect that might help that rate setting cycle for our FY27 rates. Like if we are going to make a change to the GLP-1 drugs. So really, the sooner the better to start at least researching these initiatives, to see what they could yield, plan designs, the teledoc, the GLP-1s, if there's anything else. At the same time, obviously the state's working on their initiatives. Those are not going to help us as quickly as maybe some of these other things that we could react to if we could change the formularies on some of this stuff, getting into that FY27 rating cycle. I think that would be good to get in front of.
Okay, so we are looking at some of those today, like plan design. We'll put GLP-1 on the agenda for next time. And I think if the board is okay with this, we'll ask the management team to bring anything else from your list that we think is good, feasible, and should be up for board approval to the next meeting.
Mm-hmm.
Lisa?
Is it appropriate to consider reference-based pricing in this context or not?
Well, that's sort of, to me, that's sort of the statewide initiative side of this.
But it is money.
Oh, absolutely. It's just the question that we've sort of had before is, what's VEHI's role in that versus the state's role in that. So,
but it's still, I think you're parsing. I don't follow that. I don't follow that argument.
So we're going to talk a little bit about reference-based pricing, Lisa, and some stuff that's happened in the legislature in the past week or two. We're going to talk about that later today in this meeting, and we can decide as part of that, we can deliberate what the VEHI board is going to do around reference-based pricing. But I would put, me personally, I would put reference-based pricing in the healthcare reform bucket, and that is a longer term bucket of effort and outcomes, and it's not going to affect a plan that we have to submit to DFR in November. We could say that we're working. I mean, there's lots of things we could say, but I think that what we're looking for, Chris, correct me if I'm wrong, we're looking for more short term ways to address this.
Right, because
Not
DFR is getting
reference-based pricing is
concerned.
bad and wrong. It's
Right.
absolutely something that has a lot of promise, but in the short term, I think the ask is we need to do something to address the net position for this coming year. Cheryl?
Yes, that would be my exact thought. What strategies are strategies that can have an immediate effect, however big or small they are, and which strategies are longer term, might pay off bigger, but they are longer term, because I think we're going to have an immediate concern for FY27. And which will help sooner. So I see kind of these are things that can have an impact more immediate. These are things that we need to keep working on that have a longer term impact.
Thanks, Cheryl. And Mark, last comment.
I would just qualify your comment about reference-based pricing by saying, if reference-based pricing passes this session, for the public sector first, VEHI in the state of Vermont. And if it goes into effect reasonably soon, let's say January 1, which is our objective, and I'll talk more about that later, that will impact actuarial projections by Blue Cross Blue Shield of Vermont, which will impact rates going forward, which could have a very positive direction for our reserves. The same will be true for hospital budgets that are going to be set this year, which I think could be very different from past years, more favorable to us because of the revelations about University of Vermont Medical Center's expenditures, et cetera. So I think while I agree generally that it's in a healthcare reform bucket, depending on when it comes to pass, it could have a more immediate impact on premium rate setting.
Thank you. All right, anything else of any urgent comments? Okay. Thank you, Chris. Appreciate it. All right. All right. Keeping with the financial theme, let's talk about investment performance.
Okay, so this is kind of maybe an odd time to do this. Maybe we could try to look at moving this up a little bit earlier in the schedule, because this is really a report that is taking a snapshot of time as of 12/31, or sorry, 6/30 of 24 at the end of FY 24. So we may look at moving this on the calendar going forward, so it's a little more timely. But basically the report comes from John and I. We are reporting that we are in compliance with our investment policy, that we officially reviewed that, that all of our funds are being held per policy. Talks about where our funds are being held at the Vanguard Group, M&T Bank, and Wilmington Trust. Basically, snapshot, the Wilmington Trust account had a yield of 5.2% as of June 30th of 2024. That is where it's basically a sweep out of our checking account so that we can maximize and get some interest earnings off it, but still have money in the checking account to continue to pay claims. Then the majority of our funds are at the Vanguard Group, 75% in a total stock market index fund, and 25% in equities is the target. There is a rebalancing. You have to get out of balance by so many percentage points. At the end of the year, we were 27% bonds. 27% equities and 73% bonds. So we were slightly off the target, but still within the overall range of our investment policy. So no rebalancing was needed between those two funds. So basically what we're in is we're doing two index funds, an equity index fund and a bond index fund. Pretty simple strategy, mirroring the entire market. Our portfolio yielded an 8.4% rate of return for FY 24 compared to 4.58% for FY 23. So that was a good returns year. Bond fund was at 4.66. The equity was at 23.2. So you can see that the equity fund really does help us with much stronger returns than just sticking to purely a bond investment. Both funds exceeded the benchmark, which is the Splice Bloomberg US and the Splice Total Stock Market Index. On the bond side, it was exactly the same. On the equity fund, it was just slightly better by 0.03. So basically the funds mirrored their benchmarks. CPIU was 3%. That's what we just do a little graphic in to show what the rate of return was in your packet versus CPIU. And then the last thing that's not always in the report is that I just wanted to indicate at one point we had talked a little bit, I think it was you, Mike, that asked about an investment review or possibly moving into a managed environment for our bond or fixed income portfolio. So at that time, the board did not want to undergo their own analysis at VEHI, but VSBIT was in the process of having theirs done. So we have taken that to the VSBIT board now, and we have all the results from that. And basically what we found out is that the potential for increased returns was minimal basically on the Visbit portfolio, they came back and said that they could maybe get us a third more percent. And that was with a lot more fees, a lot more risk than what we have at an institution like Vanguard. On the Visbit side, what we ended up doing was looking at some alternate Vanguard funds and ended up with a better mix of funds. So we actually achieved a better chance of, so instead of 1/3%, we got at least 1/3% to 1% better when you look at historical returns with these new funds at Vanguard. So we decided not to go to a managed approach, to continue with the Vanguard funds. Although we did tweak our invested funds slightly. VEHI is not invested in the same funds that Visbit was in. So when I look at our short-term bond index fund, I still think that's probably the appropriate fund for VEHI at this point.
I'm going to open the floor, but I'm going to take the first spot. I'd be, for my fellow board members, I'd be very interested in your, well, actually, so Chris and Jonathan, were you happy with Strategic Asset Alliance's performance?
Not particularly.
No. Okay.
It took a long time. The first time we had used them back in 2018 for Visbit, there was a different gentleman that I was working with. He was no longer with that company. Had a much different experience. This year, it took a long time. I got several reports which were meaningless. They were missing the mark. They weren't even separating our reserves out from our operating funds, which I told them multiple times needed to be done. And yeah, it was not worth, they charged $25,000 to do this analysis. It was not worth it at all. So
I've used them off and on in my career, and we had them for a little bit in Kentucky. They were the fund advisors for a national board that I was on, a national insurance company. I've just never felt like they are doing A+ work. They're doing like B- work.
Okay. So the reason why I ask is because I think it's always better to have an outside assessment or analysis done, right? So I trust you, Chris, but it's always better, especially if somebody else asks the board, are we investing them in the right way? I trust you, but the governance is, hey, we got this expert to say yes. I also did look at the investment policy. It does not mandate a review on any particular cycle. It says it's Jonathan's responsibility. So, my personal take is I would like someone to come in and do an assessment if it's not the one that you were unhappy with. But I'm just going to pause now and open it up to the board for questions or comments.
So I guess one other thing I would like to add, and I totally see where you're coming from, because this work was done for Visbit, not VEHI. But I just do want to add that I worked with Strategic Asset Alliance. Then I worked with Mercer. I spoke with them for a while because I was thinking we might use them, but they do not actually service governmental nonprofits anymore. I guess they had a bad experience with something, so they don't work with them anymore. And then I did work with our account rep at Vanguard as well. So I did, sort of look at other sources, and Strategic Asset Alliance actually went out to another investment company to have them look at our portfolio to give us some estimated returns. So, and like I said, they were probably trying to put their best foot forward because they wanted our business. And, they really couldn't come up with much as a sales pitch. So I just wanted to add that other little piece of work that was done. But I understand it was done for Visbit, not VEHI.
Comments or questions from the board? All right, so I don't know if I need to make this a motion, but I would ask that the management team come back to the board with a proposal to have a third-party assessment of our investment strategy.
Yeah, we'll talk to some other pools.
Okay.
And see who they use besides SAA.
Yep. Yeah, and maybe we could put it in the, if the board is wanting to do that, we could put it in next year's budget.
Okay. Any other comments or questions? Is it a report? What do we have? Yes, we have an investment performance report. Okay, so can I have a motion to approve the investment report as submitted?
So moved.
So-
Thank you, Cheryl. Second, Suzanne. All in favor, say aye.
Aye.
Opposed? Passes unanimously. Thank you, Chris.
You're welcome.
All right. All right, legislative updates is the next thing, and it's budgeted for 10 minutes, but it is probably going to go longer.
Yeah, I think that's right. So
Yeah,
Actually-
I want to kick this off if you don't mind.
no, please.
There's something relatively urgent came up within the last week. And Lance and I wanted to talk about it here today. So I'm going to talk to you about what happened, and then we'll have a discussion about it. From Lance and my perspective, I was notified on Thursday that something was going on in the legislature, and Mark had subsequently sent a note to the board, but from what we were told, there was an amendment suggested by the Vermont NEA to the reference-based pricing bill that was being considered by the Senate Health and Welfare Committee. And we did some looking at the testimony and the document, the proposed amendment, and found that it was proposing that VEHI take a role in a pilot for reference-based pricing. Neither Lance nor I was aware of this. And I would say it concerned us. And so we wrote an email to the members of that committee on Thursday night. And there was some urgency because that bill was coming out of the committee on Friday, or scheduled to come out of the committee on Friday. So we'll share with you that email. But it is essentially said, hey, VEHI was not aware. Please don't mandate our role in something without talking to us first. And so I'm just going to pause there. Lance, did I miss something?
Some of the screen popped up. I'll try to unmute. Yeah, well, just that VEHI was mentioned in the language of that amendment. You know, that because VEHI was mentioned several times in it. And so that was, you know, that was where the concern was, is that we were going to be mandated to do something without being consulted.
So the overall concern that Lance and I share is that we felt we would rather, especially from our, let's call them sponsoring organizations, the VSBA and the Vermont NEA, we want to make it clear to both of them that if they are going to propose something to the legislature, or make it clear to the legislature, if they want to have VEHI be part of a new statute or a change in law, that we want to have a seat at the table, that we want to give our input before there's legislation that mandates us to do something. And so the concern is that we did not have a seat at the table for this proposal. Now, in the end, on Friday, the proposed amendment did not get approved. So there is no mandate. VEHI is not part of the bill as it stands today. So before I open it up for discussion, is there any question or comment from board members about about the experience that Lance and I had with this situation before we delve into it a little deeper?
Yeah, and I think it's good to note that that piece of legislation is still going through, and it still has some reference-based pricing language in it. It's just that the VEHI was taken out of it, right? I mean, that's how I see that.
Correct. Yeah,
So,
it's
yeah,
it's
yeah.
a
So it's
bill.
still, the bill's still moving, there's language that, in there about what they were talking about. It's just that VEHI has been removed from it so that we're not going to be necessarily mandated to do anything, within the language. We may end up having to have some involvement with it down the road, or, I mean, obviously, if there's something to do with it, we're going to have to consider it, right? When we do plan design and just kind of, set rates and everything, it is going to have an effect on us. But we aren't being told by someone that you're going to need to do this and not have been able to say anything about it. I mean, that really is the gist of it.
Any comments or questions from board members before I ask the management team to weigh in on this?
True.
Suzanne?
So I guess I'm a little unclear about the the amendment came from the committee,
The amendment was
right, to the for the
to
pilot
the
piece
committee.
and naming VEHI.
from Vermont NEA.
Oh, okay, it was a Vermont NEA initiative. Okay,
Yeah, yeah. Actually, Colin and Jeff both testified before the committee.
All right. So I think, yes, thank you, Mark. I was gonna actually ask you to speak on this, please.
Thank you, Mike, and Lance, both. I'm going to put to the side just for a moment the issue of seeing something before it takes a life of its own in the legislature, because I think that's a perfectly legitimate conversation to have. And the kind of protocols we need to ensure that happens is something also that should be discussed, because in some sense, we're on new ground here. So the bill in question was not technically a reference-based pricing bill. It was an omnibus healthcare reform bill being drafted in the Senate Health and Welfare Committee, as Mike alluded to. It's a very big bill, has multiple pieces to it. It does reference the Green Mountain Care Board beginning some work around reference-based pricing this fall, I think, as a foundation for building toward global budgets for a select number of hospitals in 2028, and then all hospitals in 2030. So there is a reference-based pricing provision in the bill that's specific to Green Mountain Care Board. The omnibus bill as a whole had no reference to VEHI. This last week, the chair of the committee, Jenny Lyons, asked Vermont NEA and VSEA, the Vermont State Employees Association, both of those unions are the moving party here for a public sector first approach to reference-based pricing. Asked for language about how that would be incorporated into the bill if the committee was amenable, and how we would suggest structuring that. That was the language that was submitted as a draft amendment. It never, as Mike said, made its way into the bill. It wasn't even drafted by Ledge Council. And the request for the language came relatively soon to a vote on the omnibus bill as a whole. That bill was going to get voted on Friday, March 14th. And in fact, that did happen, went out of committee on 5-0 vote, when now it's on its way, I understand, to Senate approves. So the amendment that Vermont NEA and VSEA drafted, and frankly, that did not receive really in-depth testimony because of time pressures, is still in progress. It is being revised, and we do intend to resubmit it for consideration by the Senate Appropriations Committee. Now, to the question of a mandate.
Sorry to interrupt.
Sure.
When you say we.
Sorry again?
You say we intend to resubmit it. Who do you
Vermont
mean?
NEA and VSEA, because we're the moving party, right? And we have talked about a public sector first approach in the past. I think, been clear that Vermont NEA and VSEA are interested in this. That was the whole purpose of doing the Green Mountain Care Board analysis. But to date, there's been no language, legislatively speaking, to make that possible. That only happened at the request of Senator Lyons last week. And as I just said, and as you said, Mike, it didn't get into the bill, the omnibus bill. But it will be up for discussion when the Senate Appropriations Committee takes up that bill and decides whether or not to include it in the bill. To the question of a mandate, and I think this is important, whenever the legislature mandates something around healthcare, they might remove a service from a cost share, they might cap a cost share. They made changes last year to prior authorizations that the insurance carriers weren't happy with. Whenever the legislature acts in that regard, however deep they go or shallow, the implementation is always on the commercial insurance carriers. So anything VEHI in the state of Vermont did around reference-based pricing would ultimately have to be implemented by our TPA, Blue Cross of Vermont. The same would be true for the state of Vermont, or, and this is in the draft bill that Mike alluded to, you could actually hire a Medicare repricing vendor to do some of that work in collaboration with Blue Cross, separately from Blue Cross, or not at all.
I'm sorry to interrupt, Mark, but both Lance and I agreed we didn't want to dive into the details.
Okay, I'm sorry. I think all I wanted to make clear is that the mandate question is not quite as complicated or as new as it appeared from the descriptor, right? Anytime the legislature acts on a healthcare reform measure, it's going to be the commercial insurance market that implements it. And that's true for the Green Mountain Care Board as well. So I'll forego any comments about the details of the bill. We can, if you want, return to the question of how we share this information or knowledge with each other going forward, and the intersection of an initiative that's unique to Vermont NEA, or in this case, VSEA, and VEHI in the state of Vermont. So I'm happy to have that conversation. I have to say, though, ultimately, it'll need to involve Jeff Fannin and others, I think, because we're probably going to need a new protocol around how we do this, right? And again, I'm not opposed to a protocol at all.
And I think that's what Lance and I were discussing, that we need to make clear to our sponsoring organizations, the Vermont NEA, the VSBA, and the legislature, that we're ready to have a seat at the table and we deserve it. And not to have these conversations without us.
Fair enough.
Suzanne?
So I guess my only confusion now is whether or not this borders into our conversation about legislative action and whether VEHI gets involved in legislative action, or do we kick it back to say, okay, we let it go to our two constituent parent groups. And I might be totally off course, but I think there's some connection here about figuring out how we deal with legislation.
I think that's where I'm struggling a little bit too, because I don't think we've ever been on this ground before. I think this is new. And VSBA is taking a kind of hands-off approach to the legislation.
Bobby Joe?
I'm just curious if the difference here that's different is that what was suggested last week directly impacts VEHI's day-to-day operations and how we operate as a management team. So what was proposed by the Vermont NEA would have a significant impact as far as contracting. We would have multiple new contract vendors to contract with. I would suggest we would have a RFP, to do these kind of things. So I felt like that they were putting the cart before the horse. We don't know what the cost is. We don't know what the who we would be doing this with. And it was all of a sudden, we were supposed to be doing it for January 1st. So I think that's kind of the difference from other things that Vermont NEA or VSBA might be introducing it. Other things that have been introduced didn't impact the day-to-day operations of VEHI.
And not just the day-to-day operations. I would say that it's changing the scope of our responsibilities, right? If we are now going to be responsible or accountable for a reference-based pricing pilot, that's something that the board, I think, needs to say, yes, we are prepared to do. Or, right, or at least the board needs to have a dialogue about it and make our thoughts known to the appropriate parties. But so I do absolutely, I agree with you, Bobby Joe, and some more. That if we're going to be asked to do something as an organization, the board needs to deliberate about it. Mark?
Yeah, I have no qualms about that deliberation. In fact, I would love to have a lengthier, more detailed conversation about reference-based pricing. I think that's imperative, and I'm sorry actually that it didn't happen sooner. Given the analysis, the summary that I wrote about it. Again, I'm not blaming, I'm just saying, I think we're a little bit behind the 8 ball. Nonetheless, it doesn't mean going forward we can't do things better. And it's hard to have this conversation now without diving into the language itself, which we're not going to be able to do for time constraint reasons. But I do want to say the language does not require VEHI to hire multiple new vendors. So when we actually dive into the language, which I hope will be relatively soon, I'll walk you through it, explain why it is the way that it is. But the intention is not to put onerous new responsibilities on VEHI or to contract with multiple new vendors. And I think the language that will be submitted soon will make that clear. And if it's not, I will try to clarify where that's necessary. But yes, let's have a conversation soon about it, very soon.
All right, so I think with the board's approval, Lance and I discussed going back to our respective sponsoring organizations and asking them, reinforcing with them that we want a seat at the table if VEHI is going to be given, or if they're proposing policy or legislation that involves VEHI's responsibilities.
I think that's an absolute. I mean, and I understand you have to be somewhat nimble in terms of reacting to what's going on in the legislature. And that may not be easy for us. And so we might have to figure out how to deal with that going forward. But I really do think it's important that the VEHI board is aware of legislation that specifically mentions VEHI and what that may or may not mean for us. So I think we do have to figure that out and how we can participate in what's going in or what's happening at the legislature. So, it's going to be tricky in order to figure out how we react quickly to some of those things.
Yeah, and I think that when you see the language of the email that we sent, you'll see that Mike and I were very careful to stay neutral, and it just says what Mike said. If you're going to name, if you're going to have VEHI in this, then we need to be consulted, and that's really it. It wasn't taking any stance. It wasn't, for or against anything other than that. Yeah, there it is right there.
Okay. Any last comments or questions on this particular piece of legislation? Okay. So question to the management team, are there any other legislative matters that there's an urgency for the board to discuss or be aware of today?
I think the only thing I would add in response to that is that things are moving pretty quickly right now, to Cheryl's point about nimbleness and how we thread this needle and keep everybody informed. The Blue Cross situation is probably the most urgent for our consideration of what we do going forward. The carrier's in real deep trouble right now. Testimony last Friday by Owen Foster, Green Mountain Care Board, Mike Fisher, the Office of the Healthcare Advocate, and Emily Brown of the Department of Financial Resources, the Department of Financial Regulation, DFR. I've never heard anything like it in the 20 plus years I've been doing this work. Mike Fisher described Blue Cross becoming fiscally insolvent as the equivalent of Armageddon. And I know Mike Fisher, the other Mike Fisher, and like our Mike Fisher is judicious in his comments, is not hyperbolic at all. Emily Brown's testimony was also just really illuminating in the worst way possible. And there is genuine support for reference-based pricing emerging in the legislature in a way nobody, I think, would have imagined at the start of the session. And a recognition, this will be my last comment, that there needs to be far more regulatory work and authority in Vermont vested in the Green Mountain Care Board, including in expanding their staff by as many as 15 positions over the next 3 years. We have never faced a healthcare crisis like the one we're facing right now on all fronts. So the legislature, for the first time in probably close to a decade, is having a lot of conversations about things they didn't actually anticipate having when they started. And thus, a lot of requests for information and language and testimony is coming from different quarters. And we're going to need, I think, to monitor it very carefully. So I'll leave it at that.
Thank you, Mark. All right. So that was way more than 10 minutes, but an important discussion. So we've got, just to look at the agenda, we've got 40 minutes on plan design levers, 40 minutes on bid considerations for Blue Cross Blue Shield. Got an 2 hours. Okay. So let's move forward with 40 minutes on plan design levers.
Oh, I wanted to just take 20 minutes and kind of talk about some of the things that I've talked about over the years, or over the months, about different plan design options, and also some of the things to try to get a deeper understanding about things like actuarial values. We talk about that and we joke that it's really confusing, but I think it's important that we understand what those mean and kind of the plan designs that we have in place, and what it looks like on their own and what it looks like with the commission's benefits. And I know we can't change what's going on at the commission level, but I think fully understanding the impacts, I think, is important in order for us to have a full conversation with them as time goes on. So one thing that we've talked about numerous times in different avenues is potentially dropping the plan designs down to 2. So I took the liberty of looking at our plan designs and coming up with 2 plan designs that I thought would kind of fit where I thought, some of the things that Mark has talked about over the years, some of the things that I've talked about, with regard to, some things Mark has mentioned is, people miss having copays. People miss having these simplified plans that just have a copay at the doctor's office versus, deductibles and then HRAs being reimbursed. So I'm going to share my screen and hopefully we can, it won't be too painful to kind of talk this through. And I'm happy to answer any questions as well. 1 second, and I'll share my screen. I just want to kind of hide these two on the end first, so we don't get too caught up in that portion of it. If we just look at our plans as they stand today, we have a platinum plan, a gold CDHP, and the silver CDHP. Can everybody see the screen okay?
Yeah, what does CDHP mean?
Consumer Directed Health Plan. And when these plans were introduced, the thought was they would go along primarily with an HSA. They're HSA compatible. There are certain IRS rules that go along with it. To some, changes over the years. The HSA is only allowed on the silver CDHP at this point, but all of these have an HRA, and we'll talk about that. But to just look at our plan designs kind of as they sit, our platinum plan has a $500 deductible, has an out-of-pocket maximum for medical of $1,500. I mean, if we think about a deductible, if we know we're going to get in a car, we get in a car accident and we know we have a $500 deductible, we know that means, shoot, we have to pay $500 out of the cost of this. So, that's where the deductible kicks in. And then all of our plans, well, let me get back to that after. So if we just look at the platinum really quick, so it has a deductible, it has an out-of-pocket maximum, it has co-payment. This has a fair number of folks in it, pretty small. I have the numbers and I'll get to them after. The gold plan has a bit higher of a deductible, $1,200, higher out-of-pocket exposure, and again, has some co-pays. But a lot of the things like, inpatient and outpatient go to deductible. So those kind of higher big ticket items go toward deductible. The plan that almost everyone's on, it's about 85% now that are on the gold CDHP. This plan has an $1,800 deductible. Now, if you ask anybody that has this plan, I bet there's not a one that can tell you that their deductible is $1,800 because they don't really see that portion of it. But the $1,800, once that's been met, in theory by the member, then we kick in at an 80/20 copay. Or excuse me, co-insurance, and the maximum out of pocket is in this line, the 2,500 or the 5,000. And this is really what the commission's statewide bargaining is really based on, and I'll show you that in a minute. And then we have a silver CDHP plan with a little bit higher of a deductible, but the out-of-pocket maximum is actually quite a bit higher, so it doesn't make it a very advantageous plan to pick, although we have seen an increase in selecting that plan. Basically, the way these two plans on the right work is you have a big deductible, and then it's covered at 80% until you hit this out-of-pocket exposure, this out-of-pocket maximum. So there's no copays. Your preventive care is covered at 100%, and prescriptions are all subject to the deductible. Everything's subject to the deductible. They're pretty simplified plans. And now let me just show you the two. All right. So if we look at the new plans, I'm just going to hide a couple. Just try to make it a little simpler to see. The two proposed plans, and again, this is high level draft, trying to come up with what's kind of our next gen plan look like. These are not set in stone. All of these numbers are able to be adjusted. I'm just trying to come up with, let's look at what we can do to make some changes. I would suggest that we keep a platinum style plan, which is a co-payment style plan, still has the lower $500 deductible, lower than the gold. Still has co-payments for things like your office visits, specialty visits, mental health. One thing that I had mentioned to Mark about is Mark has, since I've known him, has talked about having primary care for free. And my only concern with putting that in the plan to have not have a copay on your primary care is I believe that mental health and substance abuse has to be at the same level. So if we made all primary care free, we would be making all primary care, mental health, and substance abuse all free. And I'm not sure we'd be willing to take that leap, but of course we can have anything priced out that we want to. So these are kind of a high level look at these. The other thing I was thinking about, instead of having the gold CDHP with a deductible and then the 80/20, is just making it a flat deductible and out of pocket is the same. Instead of having this interim 80-20%, just make it flat across the board. And these deductibles could be stacked deductibles. And it starts getting into a little bit of weeds, and I apologize for that. But on our gold CDHP plan, the out-of-pocket exposure for the gold CDHP for a single is $2,500, but for a two-person parent, child, or family, it's $5,000, and that could be one person meeting it on their own. So having an aggregate deductible, which is what folks have today, that's where most of our people are, make it a little more expensive on the front end for the member, because they have to meet that entire amount before the 80/20 kicks in or the 100% kicks in. Where on a stacked plan, which is the suggestion for our next generation plan, no individual would have to meet more than the individual deductible. So if the deductible in the out-of-pocket went from $2,500 and $5,000 to $3,000 and $6,000, no one person would have to meet more than $3,000 themselves. So if, there's a lot of families out there that, maybe the one spouse has a lot higher exposure or higher claims than the other. Today, they're looking at a $5,000 exposure. Next year, they would be looking at a $3,000 exposure. So there's actually a win there for the members as well. So I wanted to at least get some ideas flowing. This would push back the amount that folks have to pay. This would push back the amount that before VEHI starts paying. So this could potentially reduce the premium, reduce our exposure, but also the folks that have this plan today with the HRA, there's only a small number of people that it's going to impact, moving from having a $2,500 out of pocket to a $3,000, because it puts it on the back end. So I think there's some wins for both the premium and for the member in this case. So, I know this is these plan designs are kind of intricate, and it gets a little crazy, especially when you lay the HRA on top of it, because with the HRA, no one has a deductible today. There's not one person that has to pay a deductible on our plans because of the HRAs. So the fact that we're moving the deductible up, there's not going to be a significant impact to members for that change. This is kind of a high level. My thought is we come up with a couple of plan designs. We tweak things as folks want to see. I've gone over these at a very high level with John and Mark last week, not to any depth at all, but we could look at these and at least have Blue Cross price them for us at what did these plan designs look like on their own without the HRA. And then, okay, what does it look like knowing the HRA that's in place until through 2027? So if we could at least find a small amount of premium savings, this could go into effect in January of 26 if we really wanted it to. But we won't know what those impacts to rates are unless we have Blue Cross just run a suggestion for us. And in order for it to be in our filing, it would have to be, this has to be looked at now and talked about prior to June. So again, no decision has to be made today other than let's at least get it priced and see what it looks like. All of these, any of the more longer term things that we're talking about, like teledoc, centers of excellence, potentially the potential of lower prices through reference-based pricing, all of these things can be done in conjunction with a plan design change as well. Is there any questions on this? I do have some other things prepared that I want to talk about as far as just kind of looking at the plans at a high level.
Yeah, go ahead, Lisa.
Yeah, I just had a question. My understanding of the HRA was basically that was a self-insurance program that went through the school, and it came off out of your came out of the teachers. Basically, it was part of their premium,
No,
right?
this is
No.
all 100% district
No.
dollars.
The district budgets for it completely
Okay, so
and pays for it completely. I
Okay,
can tell you
okay.
that definitively.
okay. So my question then becomes, the deductible then goes from nothing because of the HRA to $3,000?
The deductible today is 1,800 and the deductible would go to 3,000 in this scenario, but that their HRAs are still in place. The HRAs are not changing. The HRAs were put in place by statewide bargaining. So in this instance, for example, a para educator on a single plan receives an HRA valued at $2,200. So the
Okay.
$2,200 goes toward the
Would go to
2,500.
3,000.
But so,
Okay.
yeah, so the first 2,200 would be on the district and the last 800 would be on the member if they got through, if they had that much claims.
I think what would be helpful, Bobby Joe, when we look at this going forward,
Mhm.
is some more scenarios like that. Right?
And I do have, I think some of the slides I have are going to be helpful to kind of look at that as well.
Yeah.
Cheryl?
Carol?
Yeah, I really like the idea of going to two plans. It really administratively, I've heard it across the board from school districts having to administer 4 plans when the predominantly people choose the gold CDHP. But you have to deal with, you have to administer, you have to explain, you have to account for all 4 of these plans. And, schools are getting pressure from all over the place. Everybody talks about administration in schools, and, this points to why we have so many, why we need people in our offices, because we have these things that we have to administer and we have to deal with. So I really think going down to 2 plans, I think is really helpful. And I really like that idea.
And I'll just follow up to say, there's a potential, that we could go to 1 plan. I just don't know if people would be ready for that leap. As far as saying, all right, we're only doing this, new revised, gold CDHP version, and we're not even going to have the copay plan, but I don't know if people are ready for that. Maybe we go to 2 and then eventually we get to 1, but I don't want to make that statement, but Lance?
Thought that the HRA was an 80-20 split.
No.
I thought the
No.
school boards put 80% into the HRAs.
No.
No.
They put 100% into the HRAs, because that's not what I
Correct.
remember when I was using my healthcare. Is that we would run out of money in our HRA, and then we would have to, I'm just trying to think, the numbers that ring a bell for me are that the HRA covered the first $4,000 of our family plan, and then we were on the hook for 1,000 before it kicked in and covered 100%. So we did have, $1,000 exposure. That's how I remember that plan working.
Yes, you're right, Lance. So premium aside, we're not talking about premium, we're just talking about claims. So the HRA is, so in your example, you were a licensed teacher on a family plan. Your HRA was $4,000. Your exposure was $5,000. So but the HRA paid first. So the HRA paid, then you were on the hook for 1,000 if you got that far. Some people don't get that far.
That's right. That's right.
And then above that, VEHI picks up the rest. So it's HRA, member VEHI. Yep, you're right.
Right, right. But I just want to make that clear because when Cheryl was talking, the way it sounded to me was that there's no exposure for you know, for the users, that, you know, that
Oh, I
that
never
the
said that.
HRA covers all of it.
No,
You
I
know,
think
the
what
HRA
she,
covers it and then VEHI covers it. That's what it
Yeah.
sounded like. That's all.
yeah.
No,
what I think-
my clarification is the HRA is fully funded by school districts.
Right, to 80%.
No, whatever
They
the
pay 80% of it.
No, whatever whatever the HRA is, the HRA may cover 80% of the deductible, but the HRA
exactly.
is paid 100% by the school district, just like health insurance premiums.
Yes,
I
yes.
think
That,
when we look at the scenarios, Bobby Joe,
Mhm.
I think what's helpful is not just to explain what's covered by what, but to actually delineate the burden, right? How much is the staff member going to pay? How much is the district going to pay? And then, you know, over the
Yep.
whole exposure. Because I think, and that's also indicating, because we're talking about adjusting the plans, but the commission is can adjust the HRAs, which lay on
Mhm.
top of it, right?
Mhm.
Okay. Mark?
Yeah, I think I'm gonna bridge Lance and Cheryl's comments. So the reason an HRA is funded by the employer entirely, whatever the amount is based on collective bargaining, where there is collective bargaining, is because of IRS regulations. An employee is not allowed to contribute to an HRA, unlike an HSA. And then to Lance's point, it's not the case that school employees don't have a deductible liability, and Bobby Joe clarified this later. They do, for example, with the family plan and the gold CDHP, they do have $1,000 on the back end. So that deductible liability is a shared liability, with the 4,000 of the 5 being on the employer first dollar and the 1,000 for family coverage on the back end for the employee. And then, of course, as already mentioned, there's the 80-20 premium split. I'll let Bobby Joe go through the rest of this before I say more about how I'd like to proceed with it. But in fairness to her, because she did a lot of research, let her go forward.
And FYI, we're about 20 minutes into 40 minutes.
Can I make one quick comment, Mike? And it's just that sometimes I think we're getting hung up between deductible and copay, because the deductible was 3,500. If you've got 4,000 in your HRA, your deductible is 100% covered. It's the co-sharing. It's the 80-20 co-share once you meet your deductible. I know this is getting in the weeds, but those are distinctions.
All right, Bobby Joe, keep going.
All right, so so I'm just going to go through quickly. So, and I can send these slides out after. So I want to just say that the gold CDHP is 85%. We did see an increase in the silver, and they went up from 2% to 9% after the HSA option was pulled. Platinum and gold are each 3%, very small. Talking really quickly about actuarial value. So actuarial value, and this comes from the healthcare.gov. It's basically an average a person would be responsible for on their health plan based on the benefits. So, and I'll show you what those look like. So these are the plans
Wait, I'm sorry,
on.
Can you just go back for a second? I was just reading.
Oh, sorry, yeah.
Yeah. 30. So the actual value is the portion they're not, the person is not responsible for.
It's the correct, yes. Yeah, it is the amount that the plan is going to pay on your behalf.
Thank you.
So if you look at the QHP plans, and this is where the golds and the platinums all came from. So a bronze plan generally pays 60%, silver is 70%, the gold plans are at 80% and platinum is 90%. We made a mistake by calling these plans because ours don't align with these. So if you look at our plan designs with the commission set benefit funding, where people on Vermont Health Connect Gold are paying they're paying 20% of their claims. Now this is talking claims. Our licensed folks are paying about 2.6 and our non-licensed are paying 1.4 on the back end. So it's quite a bit different with the HRA involved or HRA.
Sorry, I'm sorry, go back to, you're saying with the HRA layered on top, these are actual percentage of the actuary values.
Yes. And if I go here.
So when people are telling me, and when I hear, hey, the school teachers have a sweet deal on insurance, right? I've had school board members say that to me. That's what they're talking about, is the actuary value of 97 and 98%.
Yes.
Okay.
So this is how we designed our plans. So if we take the HRA out of it, our plans are at 87%. And that's actually just 0.6 too low for a platinum plan. So technically ours are just shy of a platinum plan on their own. But when you add the HRA.
Sorry, who defines what's a platinum versus gold?
The Health and Human Services. This
Okay.
is federal. Yeah, these are their determinations.
Okay.
And for the record, it goes 2% either way. So 78 to 82 is a gold. So our gold is technically 87.4, almost platinum. When you add the HRA impact, it adds 11% to the non-licensed, 11.1, and an additional 10%. So that's why when we talk about these plans being, you know, really a high AV value, that's what we're talking about. Again, really quick, as Chris was mentioning before, you know, if you look at VEHI as designed, it's an $1,800 deductible. You tack on another $700, and that 20% co-insurance to $2,500. For a licensed employee, there's no deductible. Their co-insurance is $600 on the back end, and their out-of-pocket is $600. For a non-licensed, it's $300. So there's no deductible, and on the back end, they're paying $300. And that's all fine. I'm not complaining about it. I'm not saying anything bad about it. I'm just recognizing and trying to be transparent about what these plans actually look like. Mark?
Yeah, Bobby Joy, I just want to clarify, there is a deductible. It's just paid on the back end.
It's not a deductible.
It's not a first dollar deductible.
It's not a deductible at all, Mark. It's co-insurance. So they're not even paying a full amount. They're paying 20% at a time, which is co-insurance. It's not deductible. Their deductible's been met.
They have $1,000 obligation of the 5,000 maximum, correct?
Yeah, they have an 20% co-insurance up to $1,000. Yep. I'm not saying they don't have something due. I'm saying it's on the back end after their deductible has been covered for them. And it does make a difference whether it's deductible or co-insurance, because that's whether or not I'm paying 100% or I'm paying 20%, because co-insurance is still being covered by VEHI at 80%.
For the person paying the bill, though, that may be a distinction without a whole lot of meaning, right? You still got the $1,000 you got to pay, right?
On a $5,000 service, yes.
Right.
Yep. If we can talk quickly about benefit leveraging, that's something why it's important that we make changes to these plans over time. These plans have been in place since 2018. And what happens, and I think Chris talked about this last time, if we look at a charge, so that the green on the left is a total charge, you know, a $20,000 service. Well, if that goes up 10% each year, it's going up to, it was 20,000, 22,000, 24, 26. But what happens is the member's still paying their flat amount. Even the district is still paying their flat amount. But VEHI's cost is going up each year. So that's why each year Blue Cross adds in a little amount called benefit leveraging, because our plans are becoming more rich each year just because costs are going up. So that's part of the reason it's important to relook at plan designs and say, okay, we can't keep them this way. We have to make some adjustments to keep up with inflation, or at least try to keep up with inflation. And I know.
But let me go back. Let me.
Yep.
When you're talking about VEHI pays and you delineate district pays, that's the HSA, right?
HRA, yep.
HRA, right? But the district is paying into the VEHI payments, right?
So we're not talking about premiums here. Is that what you mean, Mike? Is
No,
premiums?
but I mean, like the blue, right? The VEHI pays.
Yep.
The cost that VEHI pays out, we're funded by the districts, not by the employees, right? We're funded
Well,
by the
it's both.
employer.
I would say it's both, right? Because it's premiums and the premiums are 80-20.
Okay.
Yeah.
Okay, thank you.
Yeah, no problem. We talked about utilization a little bit earlier, and I did mention earlier that trends are comprised of cost, utilization, and intensity. And I want to just put a finer point on what Mark had said earlier about intensity. So I might go to the doctor's office 5 times, but if I go and they're 20-minute or 15-minute appointments, that's one thing. But if my mom goes and hers are 45-minute appointments, we both had 5 appointments, but hers were much more intense because perhaps she has more services or more concerns. So that's part of the utilization and trend component too, is it's not just I had a visit, but I had a more intense and longer visit, and that increases costs. But to talk about utilization, each year they have to, as Chris had mentioned, there's this line of what they anticipate we're going to pay. And in FY26, 3 points on our rates was specific to utilization being higher than expected. And so that's, again, that's $12 million, 3.1% on our rate. I'm going to skip the induced utilization, but information's in there. I wanted to talk about how much people pay. So we talk about this a lot. We talk about the HRAs and the impact on employees. So I got information from Blue Cross. This is all based on 2023 data. And I went through and said, who paid what? How many people are paying out of pocket? How many people are hitting those $1,000 that Lance mentioned, or $300 if you're a paraeducator? And here are the numbers. So 49.5 or 50% of people pay 0. So 50% of the folks that are on Gold CDHP in 2023 paid 0 because they didn't have more services than their HRA. So 50% of people pay nothing for any of their healthcare. Now, there's a number of those, maybe 9%. I have to find it. That had no claims at all. Those are included in there, but 50% of folks paid 0 for claims costs.
Right, because they do pay premiums, right?
Yep, they're still paying their 20% out of their premium, out of their paycheck. Yep. The second bucket, about 12.5% paid between a quarter, and it's literally a quarter. That's what it came up to. So 25 cents up to $300 was 12% of people. So now we're up to 62% of folks that have paid less than $300 for all of their healthcare needs. And then 16.6 paid between 300 and 600, and then 21% overall paid between $600 and the full 1,000. So those are, I think, pretty striking numbers to know that we can make some adjustments on our end, and knowing that 50% of people have the exposure today. And maybe that number comes down a little bit, and maybe that helps the program overall by having a little less cost for everybody if we can reduce the cost a little bit.
Lance?
So of the folks that don't, the 49.5% of people who don't use all of their HRA, so that money stays with the district. Do we have a number of how much of that money stays? The district has that money, And so if they're not using all of the 4,000, so for instance, someone uses 2,000. So there's 2,000 more in that HRA. The district has that money. Do we have a number on that? So we know, I
do,
assume they
actually.
roll it
Yep.
over into the following year. So do
Yep.
we have a number on that so that we know how much money they're keeping?
I don't know if they're keeping it, but
Well,
and you,
they're going to use it next, I assume they use it the following year to fund the HRA.
No,
Or do they put it in their general fund and spend it on other things? I mean, what do they do with it?
so I think, and Cheryl, I'll let you talk about it too, but their exposure is X. I have 100 people and I'm exposed to $4,000 each. So that's what, $400,000. I'm going to budget 80% of that because I don't think I'm going to have the full 400,000. So I'm going to only budget 3,000, 320,000, whatever it happens to be. And Cheryl, you can talk about that.
right, exactly. I think what a lot of us do is we can run reports through our third-party administrators, and we can try to get a read on the utilization of the HRA through our district for our particular district. Because I'm sure utilization by district varies a little bit based on your makeup. If you have a lot more younger staff, your utilization may be a little bit less. If you have an older staff, it may be a little bit more, those kinds of things. So we run reports from our third-party administrators and we try to get a read on what our utilization is. And then we kind of play Russian roulette and pick a percent of HRA that we're going to budget for. Because if you're in a district like mine, whose budget got voted down the week before last, that's spending $2,000 less than the average, student, I cannot afford to budget any more than I absolutely have to for HRAs because of the impact on my budget. So I look at that utilization, I take a chance on how much I'm going to budget for as a percent for each HRA that I need to budget for that I know about, because that all changes over the course of a year. And I hope for the best. I've never really looked at the utilization stays fairly consistent in my district, so I think overall I do okay. I've never looked at how I do, I have so many things I have to look at. I've never really looked at how I do based on what the utilization actually was compared to what I ended up budgeting. In my case, when we get the feeds from our third-party administrator, every single week, we're going through employee by employee, charging that actual expense out to our budget. So at the end of the year, we've recorded the actual HRA expense incurred. So I don't have anything. Well, I record actually what's incurred. How I do in terms of was I above or below that? I've never really looked at it because like I said, I have so many other things. That money it does go to if I do better in terms of the utilization was a little less than what I ended up budgeting. Yes, I would have a surplus there. If we did a little worse than I budgeted, then we would have a deficit there. It all goes into the general fund with all the other surpluses and deficits. Districts are budgeting in some cases 9 months in advance of when expenditures actually occur. So there's a lot of that going on in the course of a year. It does go to the general fund. By statute, surpluses need to go back to the taxpayers. So you take that surplus and you can make different decisions based on your district on how that gets utilized, but in the end, it goes back to the taxpayers.
So you think that basically school districts don't really track the percentage of these HRAs that are actually getting used, or?
Oh, yeah, we do. You can get it from your third-party administrator. They can tell you exactly,
They can tell, okay,
they can tell you exactly person by person what the utilization of the HRA is. And I look at that in total and come up with a percentage that says, okay, I need to budget for 80% of HRA utilization in my budget. Because I'm not going to tie up my budget using 100% of an HRA because I pretty much know my budget's going to get voted down. And my margins and my budgeting is so tight, I cannot afford to do that.
okay,
Well,
so like, let's just say, for instance, that your HRA needed to be funded, if it was gonna be funded at 100%,
It
then
is.
so it was $100,000, right? So you're gonna actually earmark 80,000 for it, because you're gonna kind of keep 80% of what, you're gonna budget 80% of what it is. So, and then if you use $60,000 at the end, if everybody has, gone through and is end of the school year, you've
Mhm.
only used $60,000 of that money, that extra 20,000 would go into the general fund?
General fund surplus, which goes back to the taxpayers.
Okay. Yeah, that's what I was looking for. I just want to see
Yep. Yes.
how districts are, and they keep really good track of it, so they know what they've spent, and and then you probably use that for future years. Like, we were at 60, we only use 60%, we used 50% the year before. Maybe you can just do it to 75% this year. You just kind of gauge it, or?
No, because that's gone. At the end of the year, that's gone, and that money is now in surplus. I can't earmark a portion of that surplus to help in a subsequent year if I do
Oh,
a
yeah,
bad
I get
job
that.
of predicting what it might be.
But I just like predicting how much you're gonna budget for in future years. You kind of look back at past years and.
No, honestly, really, I get a report from the last year completed. So, I'm running a report. So when I'm doing my 26 budget at the end of January 24, at the end of December 24, at the beginning of January 25, I'm starting to run reports to see what the utilization on the HRA has been to gauge what I'm gonna budget for
next
Hey,
year.
Cheryl and
HRA.
Lance, Cheryl and Lance, I'm gonna
Mhm.
ask to
Yep.
wrap this up, and because we do have more agenda items, and I want to go back to the overall ask from the board, which is looking at plan redesign. So Bobby Joe, you've gone through a bunch of slides, not your entire presentation. So I'm going to ask you to finish your presentation, and then the board will decide what action to take next. So go ahead, Bobby Joe.
Okay, I just want to make two more points and then we can be done. I do want to note that non-licensed single folk, so the ones that have an exposure of $300, 68% of those folks do not have to pay anything out of pocket. And I think that goes to show the work that was done on their behalf to make sure that they have really great coverage and really a really rich HRA to help them with their costs. So that was the high number, was the 68% not having to pay anything for any of their claims. And then I wanted to just get to the HRA point that Lance was making. And does anyone have any guesses on the amount that outside of premium that schools are paying statewide for HRA dollars? Any guesses?
100?
100 what?
Isn't it
Million?
wait, no, oh, you're talking about a dollar amount.
Yeah. So our premiums are, headed toward 400,000, and of the 400,000, 360 is our no, sorry, that's
I mean, 400 million.
Yeah, 400 million.
Million.
400 million, and people pay 80/20. So if you take 400 million, so how much do you think is additional costs that they're paying? About 320 million in premium at 80%. Well, it is This is just gold CDHP, and it is for 2023. So we know it's gone up just because costs and utilization have gone up. $33 million was paid out in 2023 out of HRAs. That doesn't include golds, platinums, or silvers. This is just 2023 gold CDHP. And to your point, Lance, their total exposure for this group was 44 million. They paid out 33 million, so it was about 76% average. And I think somewhere in the 75-80% range is probably what a lot of folks do for budgeting. So,
Yep.
All right, so that's what I had to share. Just thought some interesting bits of information.
So thank you for all of this. And I think this is clearly going to need some additional deliberation by the board. But the other thing that it struck me is, and we've talked about this before, is we can deliberate and change our our plan design, but to really talk about the impact to taxpayers and the burden to employees, we have to collaborate with the commissioners.
Great.
Yep.
Mark?
Yeah, when we were talking with DFR yesterday, you know, I made the comment, I said, you know, because Emily Brown brought up about the HRA component. And I said, you know, yes, if we change plan designs and raise deductibles, it basically helps VEHI's bottom line. But if it's all funded by the HRA, it doesn't help the school's bottom line.
Mark?
So a few things. First, Bobby Jo did do an enormous amount of work. And as she said earlier, she shared the first slide, these two draft plans at a high level, either last week or the week before with me and John. I haven't actually seen them on paper yet. I've just seen them virtually. I haven't seen any of the slides until today, the longer part of the presentation, and that's fine. I will see them in due course. I want to propose, though, that before we move forward with any costing out of any new plans, that we have a longer, more detailed conversation about the different assumptions that are at play in Bobby Jo's presentation and the extent to which they will actually reduce cost or just shift them. And I'd like an opportunity after I study her material to offer a counter narrative. And perhaps between those two worlds, there's a middle ground that we can rest on. But before we actually start costing anything out, I'd like us to hear a counter narrative. I'd like to have the opportunity to challenge some of the assumptions that I think this research is based on. And I'll share one right now. There's no correlation between actuarial value and affordability. You can have a high actuarial value plan and not be able to afford a bill. You can have a low actuarial value plan and be able to afford it. It comes down to your income. I watched a man walk out of a pharmacy last summer because he couldn't afford a $400 prescription. And I listened to him argue with the pharmacist, beg actually, to be able to go home with it. And he couldn't afford it. So he left. I picked up mine. I could afford it. I left. He could have had a high actuarial value plan and not been able to afford the $400. I could have had a low actuarial value plan. I don't, but I could have, and been able to afford it because of myself. The other thing I'll say briefly is that there's no correlation between actuarial value and what we're charged for a service. Blue Cross shared a bunch of numbers with the legislature this year to point out the high hospital cost it was bearing. UVMMC charges on average $17,000 for an uncomplicated birth. Dartmouth's about $13,000. Those bills aren't going to change regardless of the actuarial value of your plan. There's no correlation between prices and no correlation between actuarial value and affordability. I would like the process of benefit design to, again, allow for a full airing of all those assumptions and facts where they are facts and values, and also incorporate into it some of these bigger structural issues, like a new PBM, like potentially new contract terms of Blue Cross, like reference-based pricing, because to the extent those actually work in reducing costs, not just shifting them, we may make very different decisions about what we assign to a deductible, a copay, or a co-charge, a co-insurance charge if there is. And finally, there are some pretty serious collective bargaining implications here. And I don't think these plans could be offered in 2026 under the current agreement that's in force. I could be wrong about that. I didn't bargain it, but that's something we also need to keep in mind. So I'd like us to come up with a plan for how we're going to approach design, anchored to values and principles, and then really take a deep dive into all of it with everything on the table. And there isn't time today to put everything on the table. We just ran out of time. So I would ask that we begin that process before we start costing out plans. Thank
Carol?
you.
Thanks. I know this isn't going to be popular, but so that man that walked out of the pharmacy not being able to pay for his prescription has to pay his property tax bill. And he has to pay a great deal of that towards education. So, and a great deal of our education, of our cost in our budgets, 80% of our budget is wages and benefits. So so that's where I think it starts to get really difficult, because I am frequently in very heated meetings with people in my community that are very angry about what it costs, what education costs in their community. And again, my budget is $2,000 less than the state average. So it's really difficult on the other side of that when we're working with budgets and the cost to taxpayers. So I think that's where that actuarial value really does matter, because it's, it has to be paid for by the taxpayers. And there's legislation in all this education reform that said school budgets could not increase more than 3% in fiscal year 27. I don't know if it's still in the bill. I haven't looked at it recently. That bill's well over 100 pages long, but there was a part in there that said budgets could not increase more than 3% in this interim period as we move to this new structure. That's really scary for school districts to be dealing with, because we just have to incorporate what our negotiated contracts are in terms of wages and benefits. And we get to that easily can push a district over 3%. And so the only thing you can start cutting is staff. And that's really what starts happening, unfortunately. It's going to be pretty tricky in the next couple years.
Thanks, Cheryl. Suzanne?
Ooh, I had to find my button. So I just think we need to be really clear about our mission, because I see us overlapping in different areas. And I know, Mike, you made the comment about collaboration with the commission. Our mission, I think, might be how do we maintain the fiscal solvency of VEHI vis-a-vis Blue Cross Blue Shield, et cetera? How do we come up with a plan that cost X to both the boards and the school employees? I mean, so we've got that one whole piece about what are our levers we push there. And then I think we get into the weeds right now when we start looking at what the effect, and I'm not trying to minimize it, Cheryl, or anyone else, but what's the impact on the taxpayers? Is, yes, that is a big piece of it, but it's also a piece that the commission's charged to deal with. They're bargaining You know, what the percent of premiums people pay, what are the HRAs versus HSAs versus all these other things. And so I think if we clarify our mission, and if we even agree what our mission is, we might be able to move forward in a more productive.
I really appreciate that, Suzanne, right? Because I was just thinking about, Mark's talk about shifting the burden from taxpayer from employer to employee. And is that part of our, the scope of responsibilities to be considering that? So I appreciate your comment of let's try and focus on what our responsibility is, right? And so I really like the idea of, hey, it's financial solvency of VEHI so that we can continue to offer this insurance. So why don't we have that be the last word on this for tonight? And what we'll do is, I think this absolutely deserves, everyone needs to go through that presentation from Bobby Joe, have your conversations outside of this meeting that you need to understand the content. And we'll have to come back and talk about as a board how we want to proceed, and to Mark's point, give Mark an opportunity to respond as well. All right. So thank you again, Bobby Joe, for clearly all the work to put this together. And I'm really happy that we're talking about this because we've been fixing to get ready on this for a long time. All right. We are at, we've got an hour left and like an hour and a half of content. So I think it's important that we look at this agenda.
Mike, I think that we can make a second conversation about the ASO bid considerations. We can probably make that a pretty quick conversation for tonight, unless you want to dive into it further.
Okay. You think you can make that at 10 minutes? How many minutes do you need?
Yeah, I think really, yeah.
Mark's fingers are going down as we speak. Okay. So then we've got 10, 20, 35, 10. Okay. All right. So let's move on to bid considerations with the ASO. So first of all, you got to explain what that means to board members.
What? Oh, we need to? I thought you were going to. Yeah, John, go ahead. You haven't.
Sure, I can take a stab at it. So at our last meeting, the commissioners came and asked us to go ahead and the request was that we bid out our contract with Blue Cross. And then we had a lengthy discussion about it at the board meeting. What does that mean? What does that entail? And the bulk of what we do is claims. It's ours. We own it. We're self-insured. The Blue Cross contract is pretty small. It's about, if you look at the memo, I think Bobby Joe included it, rough number, $20 million. And so where's the bang for the buck in going out and doing an RFP on our ASO? It just doesn't make a lot of sense. So knowing that, we know that, but it doesn't look to the general public like, that's great. We should be looking at things, or why are you with Blue Cross for as long as you are without at least testing it and seeing? So Chris and Bobby Joe and I and Mark worked together to come up with the memo that's in the packet. I think we are all in general agreement that there's not a lot of sense in bidding the ASO contract. We're not expecting it to be any better. We think the only way, or one of the only ways we're going to see any kind of savings from a Cigna or an MVP, and we've all seen this in the news, is probably higher claim denials. So that's not good for members. That's not good for VEHI. I don't want to see that happen. Mark doesn't want people calling him because things are getting denied all the time. That's not what we exist for. So there's a lot of information in that memo. I'd ask you to take a look at it. We talked about why are we writing this? It's not like we're sending it out as a campaign monitor. I don't know that the next step is to even give it to the commission. Is it just something we want to have while we decide what our next step is? Do we want to bid out part of the ASO? Do we want to bid out pharmaceutical? So Bobby Joe, Mark, Chris, do you have anything to add?
Can I just clarifying question?
Sure.
Does everybody have that memo in their packet?
It's not in the packet. It was added
Oh.
to the appointment later, or
Sorry.
this morning, actually. So I apologize if sometimes I do that and think, oh, people will see it, and then they just click on the appointment and don't even see it's attached. So I'm sorry about that.
No,
But
that's
everyone
right.
should have it on their appointment as a separate item.
I think John set the table really nice for the conversation that we'll probably have at greater length in the future. None of us can say definitively that an RFP bid, if it were to come, would not be less expensive for us than what we're currently paying. There's so many factors involved, and that's what we tried to get into in the memo. But to John's point, and this is a part of the conversation that I think will also come back in on benefit design, there are certain systemic problems. It doesn't matter who your carrier is, right? If it's hospital prices and RX that drive most of your spending, unless a bidder can come in and say, we can dramatically lower those costs, then there's really no savings to be had, at least none that are sustainable and trustworthy. Because we know we could get a big carrier come in, could be a Cigna or an MVP, who will deliberately underprice. They'll take a loss, right, for some period of time to get the business. But as we can all tell you on the management team, and you've probably seen it in your own lives, all those cost chickens come home to roost eventually. It's just a question of when. And so a much bigger carrier, while might be able to sweeten the pot initially, isn't necessarily going to be able to address those underlying causes that are driving prices. And admin is admin, as John said, and it's mostly claims. So unless they were willing to take a big loss on admin, it's unlikely we're going to see big savings there either.
And even 5%, it's in the memo, but even if we could save 5%, it's only $976,000. So I know $976,000 is still real money. And if we had it in our own checking account, that's huge. But in the greater scheme of this pool, it's 0.002 something percent.
And Mark made the point, I think, when we were going back and forth on the memo. The state has used Cigna, then they've gone to Blue Cross, they've gone back to Cigna. I'm concerned, I think we're all concerned, if we went from Blue Cross to a Cigna, there won't be a Blue Cross to go back to. That'll be it.
Just one more thought regarding the difference between the state of Vermont and VEHI. So Mark had mentioned that at our last meeting, that like John just said, you know, about state of Vermont kind of going back and forth. State of Vermont is one employer. They're one employer group that's set up as one entity with all these employees. VEHI is an association with 60 something groups underneath. So the hopping back and forth, we don't have that flexibility or that, you know, capability to be that to be hopping back and forth. It is a huge lift to move an entire association from one carrier to another. Again, we're happy to do the legwork if we think it makes sense, or even if it doesn't make sense. But these are just the things we want to point out to folks.
Carol?
So I appreciate everything you're saying, and it makes a lot of sense, but how do we address the concern that people might have that we're not doing our due diligence? I mean, what are we gonna say about that? Because I just see, you know, there's just gonna be more and more pressure and scrutiny on us. So how do we address that?
And I'm with you, Cheryl. I'll just give me a moment, Mark, because
please.
and I think we found something that said we do need to review it. Sorry, it's just good business sense when you have a partner contracted for a long time that you do look elsewhere and see what's out there in the marketplace. I trust all of you, right? But as a board, we need to make sure there's good governance, and that means going outside of going outside and seeing what's available. So I think, you know, if we trust you guys, maybe what we'll do is performative, but we still need to find out what's out there. So when we were planning this meeting, leadership team and Lance and I, we were talking about things like having, instead of an RFP, which is like, hey, we want a full proposal, it could be an RFI, a request for information. And that's simply to say, hey, who's interested? And we could get bids from like a Cigna or something. And it's also a fraught step because it's going to make Blue Cross Blue Shield nervous. Right. And if we know that they're in a precarious situation, we know that we're a good chunk of their covered lives. What did you say, Mark? It was like 20%?
We got about 200,000 lives, I think, Bobby Joe, give or take, and we got 35,000 of them. So whatever that percentage is, it's a good chunk.
A good chunk. So it however we do it, whether it's an RFI or something like that, Cheryl, I believe we need to do something and not just say, trust us to everybody else in Vermont. Trust us, we got this. It's Blue Cross Blue Shield. The business way to do it is we have to do some kind of opening up, but we have to do it carefully so that we don't spook the system and cause more damage just by opening it up. Lisa?
Yeah. I may have misunderstood, but I was listening to the other Mike Fisher do his presentation to the state. And I think it was he who said this. It was something along the lines that if Blue Cross Blue Shield goes under, there's nobody else to step in. Was that a misunderstanding of that? Or
No, you're correct.
right. And so to me, that's like red flag. Like we don't have a choice. You know, maybe I don't see how you can look to. Is there a connection here, or am I just off base?
When you say that you don't have a choice, are you saying there's not a choice that we now need to look? Or are you saying there's not a choice that we have to stay to keep them, to help keep them afloat? I'm not sure. I just wasn't clear which way you meant.
Well, I guess I'm not entirely sure what that meant. My initial understanding was that means we have to stay with them because there's not an alternative.
I see.
But I don't know.
Yeah, I mean, I think it would depend on the carrier who issued the bid and how big and resilient and moneyed up, if you will, that carrier is. I don't think MVP could pick it up. That based on what I've heard and read, but that doesn't mean a Cigna or United Health couldn't, right?
What is it? Who are we responsible for, right?
Yeah, no.
Responsible for our members.
Yeah.
Ultimately, right? Not the rest of Vermont healthcare, you know, insurance.
Right, but if the whole thing goes under, we're just we're a portion of that.
If we, just as theory, right, for everybody watching this recording, right? In theory, if we do an RFI, somebody else gives us a really good deal, and we do a full RFP, and we decide to move that to that other carrier, and Blue Cross Blue Shield goes under, our lives are still covered through that other carrier.
Okay. Yeah. Good. All right. Gotcha. I agree. Okay.
I'm not saying that, again, for the record, I'm not suggesting we do it. I'm not saying that's a course of action. But remember, we're board of directors, and actually we're talking about the thing from Attorney General later, right? As those directors, our responsibility is to this organization as the primary.
Yeah.
Even though we obviously care about our neighbors and everybody in Vermont. Right.
It's a consideration as part of an RFP. That's one of the considerations as we do our due diligence.
So I don't quite understand what an RFI is. I mean, I know it's not as much of a detailed piece. And I also understand that Cheryl's concern about we want to make sure that people aren't saying you guys are just sleeping at the wheel, you're in bed with the blues or whatever. I'm putting words in your mouth, Cheryl. You didn't probably mean that, but we have those considerations. So what I want to know is what can we do that is not incredibly expensive or time consuming for the management team that will give us some information that we don't already know. So I guess, you know, the RFP, I think we already know what the deal is. In fact, you know, I've been with Mark for almost, we're getting on 40 years, Mark.
Yes, we are, my friend.
It's a long time, but I remember that, you know, in the old days before school districts had to be with VEHI, they could go and shop around, you know, so Rutland would leave and go to Cigna or somebody else or God knows what, and they get a sweetheart deal for 1 year. We know the deal. It's like, oh, well, for $5.99 a month, you can have this service. And then in a year, it costs you $20 a month, you know, so what do we really want to do? And I'm going back to that again. What's our question? What do we want to show? Where do we want to go with this? And can we do this without killing our management staff?
Thank you, Suzanne. Jonathan?
So just thinking off the top of my head, we could do an RFI where we ask things like, what are your claim denial rates? What is your presence in Vermont for customer service? Who, you know, what other pools do you serve? I mean, we can just do a questionnaire to assess their interest. And then we know United Healthcare has the highest denial rates, I think, in the country for claims. We don't, you know, we can look at Blue Cross, we can look at Cigna, we can ask for references, we can do that kind of stuff. And I'm just spitballing here. Mark, you probably got other ideas, Bobby Joe as well, of something, some kind of questionnaire that we could send out to assess their interest in being the ASO for this program.
I agree with John. I think the RFI is the best approach. We try to do a streamlined version that's still comprehensive enough to give us the information we need. We may have to ask for some guidance on how to do it as effectively and expeditiously as we can, but that shouldn't be a heavy lift for us. I mean, yes, it's more work, but it's not an RFP. The other thing I'll say, and Mike makes a very important point about what I'll call business ethics or business diplomacy in this context. It's not illogical at all or irrational for people to ask us to tell them if there's a better company out there, a better carrier, less expensive, as effective. Lots of private and public sector entities engage in this kind of work. There are factors for us, though, that are so structural or systemic. And I apologize for being a one-trick pony, but I just am. I think ultimately what will make a difference, depending on the information we get, is that unless we deal with those systemic issues, it doesn't matter who the carrier is. And we have to find a compelling way to communicate that to the field. And finally, whatever we do, it's going to spook the blues. But that's unavoidable, and they're adults. They'll deal with it. They'll understand it. And an RFI should be a little less spooky than an RFP.
Mark, I really appreciate what you said about I just lost it. I appreciate whatever you said. You said something that was really insightful, and I appreciate it. Chris, go ahead.
So I think you're on the communication side, a really huge piece in trying to get out there to the reader and to the public is this whole concept of, we don't bid an insurance company and just pay a premium. You know, I think there's very few people in the state who probably really understand that we hold all the claims and that we really are talking about $19.5 million. And that includes reinsurance too. I mean, that's 4.9%. Only 3.4% of it is actually their admin. The other is reinsurance costs. So, so I think that when we figure out the way to communicate this, that is a huge piece that we really need to stress, because I think most people think of it as just like, you know, in their jobs, they've worked at their public sector, you know, whatever their job is in the private sector. And, you know, you're with MVP, pay a premium. You don't have any claims expense. You just pay the bill every month. So somehow having a document out of this that has conclusions on it that we could provide to the public, that I think that would be really important, that we could provide to the commission, because they asked us to do this, that, you know, other parties could read, that would clearly illustrate what we've done, I think might be important.
And I remember, thank you, Chris, because it's not just could we shift to a different carrier, it's what's the bang for the buck, right? And explaining that to the field, as you put it, and to say, hey, listen, we're going to put our efforts towards plan redesign, lowering pharmacy costs, right? Addressing hospital, like, we think that's the bigger bang for the buck than this, you know, 19 million or whatever it is. So,
right.
Okay. Any other thoughts on the ASO right now? Is there any motion that any director wants to make? Okay. So Lance and I will work with the management team on the next step, whether it's an RFI or something else, or do nothing, right? A choice is always do nothing.
I hesitate to make a motion at this point because I don't want to box us into anything. I think let's proceed a little carefully and see where it takes us.
Maybe it's a discussion with the commissioners and make sure they understand
Right.
the Blues role and how much impact it would actually have, and see if they're still. Yeah. Okay. All right. Any other thoughts, comments, questions? Was that 10 minutes?
Yeah, I think, Mike, I don't know if you got I sent you a message. I think I have number 9 ending at 5:15, so I think we're just 7 minutes behind schedule. So I don't think
Okay.
we're in bad shape.
Not that bad. More than 10 though. All right. Thank you, Lance. I did see that. All right. VHC 911 introduction.
Yeah, you all have something in your packet that I put together introducing you to Vermont Healthcare 911, which launched in January. I also provided links there to what we call our stat releases or documents, which illuminate, I hope, educate, edify about why we are in the mess that we're in. And I think to sort of sum up, we are paying exorbitantly more for hospital services than other states are. And UVMMC is exorbitantly more expensive than other academic medical centers around the country. You will see in most of our research comparing UVMMC to its comparator institutions around the country. The release that went out yesterday to you from me and went out to the broader world around the same time, if that number holds up, it is just staggering, its implications. That UVMMC in 2023, that's the year we have the most current data from, hospitals have to submit cost reports to the federal government, to Medicare. These reports are the most public information we have about hospital spending relative to Medicare and the commercial market as well, as it turns out. And what we are finding in that cost report for 2023 is that UVMMC is reporting an $801 million profit based on the commercial market. Now, again, that's a staggering number. It is historically in the range of 250 to 300 million, the profit from the commercial market. This is way, way out of whack. And when you consider the fact that Blue Cross is on the edge of fiscal insolvency, and Chris's very sobering summary of where we are with our reserves, and we are not alone as pools, risk pools, in dealing with all of this. Our federally qualified health centers are also on the brink of fiscal insolvency. That is, the ripple effect of that for the system will be catastrophic if they go under. Right? So what Vermont Healthcare 911 has done is focus our attention on this very big systemic problem. And in all of the releases so far, we have focused on different elements of that problem and compared UVMMC to the other AMCs around the country. And also, what's been interesting to me because of my addiction to reference-based pricing, and I'm going to get help someday for it, but 80% of the academic medical centers in the country break even or make money on Medicare. Right? UVMMC lost $114 million on Medicare last year. Now, why is it UVMMC can't break even or make money on Medicare and these other institutions can? So I would urge you, it's not deathless prose, but it's really interesting reading. Try to stay on top of those releases. Think about their implications for VEHI as we begin to address these systemic issues, both within and outside the context of benefit design. Because unless we do, there's really no hope. How's that for a little speech? And second, there's a leadership council for this entity. Vermont NEA is represented by Don Tinney on it. AFT is there, VSCA is there, several business leaders. This is the first coalition in healthcare reform in the history of Vermont where both business leaders, unions, and civil society organizations are working together. And I have to tell you, it's really invigorating the conversations because all of us are facing the same threat. And for the business leaders, I have to say they can be incredibly candid about this. And it's just been nice for us to look at each other across the table and say, you too, and not as enemies, and not talk about cost shifting, but talk about addressing what's really driving the prices. And clearly it's hospitals and it's RX, and we're not focused on RX at the moment. We're focused on the hospital. There's also a board of directors. It's a small group. I serve on the board of directors for Vermont NEA. Tom Reese, who used to work on hospitals, used to run hospitals, top-notch analyst, is on the board. Craig Jones, longtime healthcare analyst and specialist, has worked in 26 different states around the country in healthcare, helped to launch our Blueprint program, also a really top-notch analyst. Governor Jim Douglas is the co-chair. Lisa Ventris, former head of Vermont Business Roundtables, the other co-chair. Bill Schubart, writer, former head of chief trustee, head of the Fletcher Allen board when it used to be called Fletcher Allen. And Chris Pearson, former state senator, who is sort of facilitating our meetings and doing a lot of outreach work with the media and with the legislature. And finally, I'll say, whenever our reports go out, the first reaction we get is this real? It's always the first reaction. Is this real? And it's having a real impact positively at the legislature and also been well received by the Green Mountain Care Board. So I'll leave it at that unless there's any questions.
So seeing none, my question is, do you have an ask other than awareness and taking in the materials that are published? Do you have an ask for the VEHI board for VHC 911?
Good question. At this point, no, just informally, if you will, that please stay informed about what the coalition is doing. And I can, if you would like, update you on its impact at the legislature with the Green Mountain Care Board. But, oh, actually, I do have an ask. And again, it's not necessarily a VEHI ask, is that please disseminate this stuff to friends and neighbors and coworkers and those of you, especially in the business community, who have interactions with business leaders, please get it out as wide as possible. And if you know of business leaders who might like to serve on the Leadership Council, please let me know. Thanks.
Thanks, Mark. Okay. Oh, look, you did great. You caught us up. All right. So next item is we're going to review and approve protocols. So communication agenda, election of officers, duties of nonprofit board. So the first, and this is all in your packet. Thank you for including that. Oh, wait, it's not in. No, I thought it was in the packet. Oh, I'm sorry.
We're at the end, I believe.
Yeah.
Well,
it
I'd
is.
say we're at
No,
the
no,
end, except for the duties of a nonprofit board is like 21 pages. So.
That's fine. Okay. So the first is communication protocol. So we're going to look at each one of these and then, let's make sure. We'll look at each one of these. Set the whole thing. Take any comments, any suggestion for edits. And if not, we will approve them. Reapprove them. Any comments, questions, suggestions? Make sure I can see everybody. Okay. Seeing none, may I have a motion to reapprove this protocol as written.
So moved.
Thank you, Lisa. May I have a second? Thank you, Suzanne. All in favor, say aye.
Aye.
All right. All opposed? All right, it passes unanimously. Thank you. The next up is the board agenda protocol on how we build the agendas. Comments, questions, suggestions, proposals? All right, seeing none, may I have a motion to approve as written?
So moved.
Thank you,
I'll
Cheryl.
second
Thank you, Lisa. All approve, jeez. All, can't even speak now. All those in favor say aye.
Aye.
All opposed? None. Motion is approved unanimously. Thank you. Election of board officers protocol. I will say there was a discussion about this, I don't know, 2 years ago about that first meeting in what is it, October usually, or December, and who would run the beginning of that meeting. I think with this board, we're very collaborative. I don't see that we need to adjust this protocol to talk about the beginning of that meeting that's referenced here in number 2. So, Lisa, you were the only one there when we had that little dust up. Right.
Yeah, I think we're fine now. I think it's adult behavior.
All right. Any other comments, suggestions, proposals? All right. May I have a motion to approve as written?
So moved.
Thank you, Cheryl. Second.
Second.
Lisa, thank you. All those in favor say aye.
Aye.
Opposed?
Yeah.
Motion passes unanimously. All right, and then final thing is this was just a guidance from the Attorney General's office on nonprofit. And again, what I was going to highlight was the under the duties. Now, where did it say? I mean, and the actually one question I had when I was looking at this is, we're not a charity, right? We are a corporation. Is that correct? Are we a 501c3?
We're close.
Chris,
Wait,
what's
wait.
the difference between that and an intermunicipal association, which is what we are?
Say again. Wait, what did you say, Chris?
We are not technically VEHI is not a 501c3 in the IRS's eyes. We're a 457, if I remember the number right, something like that. It's been a while since I've seen that. But they are close. They are very close. But we are an intermunicipal governmental intermunicipal, I can't say that word, organization. So
are we a nonprofit?
Yes, we are. We're a nonprofit. We look and quack like a 501c3, but we're not.
So the other thing is, and we really talked about this before, is understanding your duties. Right. And the duty of care. And then there's another duty. What is it? The duty of loyalty. And so we talked, I referenced this earlier, so that we exercise our authority in a manner that believes it to be in the best interest of the corporation. So going back to that conversation we had, Lisa, yes, we should be concerned about healthcare overall, but when we vote here, we should be thinking VEHI should be paramount.
Yeah.
All right. I don't think we need to approve this. Well, actually, maybe what we should do is acknowledge that we have reviewed this. So I'm going to move that the board acknowledges that we have reviewed the duties of a nonprofit board.
I second that.
Thank you, Suzanne. All those in favor say aye.
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 Opposed? Motion passes unanimously. All right, and then finally is the mission. Where did I put it? Hold on. I'm all over the place.
I think if you keep going at the bottom.
Oh, you put it in there?
I
Oh,
think so. Oh, you know what? Maybe I didn't. Because
No,
it's
I
not
think
its
it's
own
in there.
document.
What's in
Yeah,
there?
I have it.
It was
Yeah.
in my packet
Mine too.
Oh, good.
at the very
Nope.
bottom.
Go on.
There we go. Thank
Oh.
you.
I did it, yay.
Of course you did, Bobby Joe. All right. So one of the things that I wanted to clarify was that is this statement still accurate? Right? And so we discussed this when we were planning, and Bobby Joe and you guys said it's still accurate because a portion of the Visters is through us, right?
Right.
Okay.
Under 65.
Okay. Is-
Plus a subset of over 65 that,
Sorry.
Is
it
there,
is a small, it's a small amount, Lisa.
so from the management team, is there anything in here that's no longer accurate?
Well, just going back to that statement, should that statement then have some sort of qualifier on it? Because if you were to read it, it could lead one to believe that VEHI provides benefits to retired teachers. Should it say some or a select
Subset.
subset, something? I don't know how you might qualify it, but
And so maybe what we should do is look to update this. Right? Is there other than this reference here, is there any part of this that anyone thinks we should look
Yeah.
to?
What about the post-employment wellness programs? I didn't think that was offered to retirees.
It is both retirees and spouses.
Okay.
Even those that are with BABA. So
Okay.
that's for everyone, and they pay us a per member per month fee to continue to have that benefit. Fun fact.
Yeah,
I
maybe
guess I'm
more
just
something like not otherwise covered elsewhere.
Yeah.
Or
So that actually goes to that first line because technically the wellness is a benefit and that benefit is offered to the entire Vermont State Retired Teacher System population,
okay.
even those who are no longer on the VEHI insurance.
So why don't we do this? Why don't we take this back and we'll ask the management team to make some proposed edits. But I'll also ask the board of directors, right? This is should be an important guiding document on what we do. So for example, we've had a lot of discussions on changing healthcare in Vermont and driving down costs. That's not part of our mission as it's written today. Right? So I think if we do think that should be VEHI's responsibility and we should be working on that, it should be part of the mission. If we don't think it is, then it's not part of the mission. So I think this also goes, Suzanne was talking earlier about like, hey, what is VEHI's role? What should we be doing? Should we be worrying about the employee versus employer cost sharing or burdens and shifting? And if we do, it should be on here. So my suggestion is we'll take this back. Lance and I and the management team, and then we'll bring it back at a future meeting for updation. To use one of my, to
Is
use
there a
Lance.
protocol for changing this? Is there something in our bylaws or is it just, we can just do it?
Good question.
Great question.
Yeah, maybe we should look at that, just for the heck of it.
Yeah, I know for VisBit, we can change it at the board level. I'm not sure for VEHI.
My gut kind of wants to tell me that it's board level and it's not in the bylaws, but I can't be 100%.
Back to the idea of, what is the mission, benefit plans responsive to the needs? That's pretty broad definition of, I would think that covers financial. Info. Just a thought.
All right. So, great. All right, future board meeting agenda. I am going to share this. So I've been working on this. Let's make sure you can see this. It starts with annual work plan. Okay, so all of this is what we came up with today. GLP-1 coverage, understanding, you can read all of this. Bobby Joe, when's our next board meeting?
May 20th, I believe.
All right. I'm going to propose that we organize a meeting before that. I think especially this and the reference-based pricing and the net position, we really need to move on before May.
Well, also, if we're going to talk about any plan redesign, and I know that I think Mark is correct that we can't implement something as soon as next year, but we do need to move on a lot of those things. So that does, in my mind, say we need another meeting.
How did I miss plan redesign? Cheapers. Okay.
But maybe we could move something on GLP-1 coverage. I don't know. Because that doesn't really change plan design, does it, Bobby Joe?
No, it doesn't, but it does have a big impact on. So we have, Mark and I've been barking up this tree for a while, and Mark has asked our remedy folks if they could pull some data for us, which we have not seen yet. One thing that we did learn recently is that with GLP-1s comes rebates. Excuse me, and as you rules in place, they pull back the rebates. So we're looking into that as well.
Okay. Well, I think we've got at least 3 that we want to do. And so Lance and I will work with the leadership team and we'll doodle it up and find some more time to discuss. All right. Thank you, everybody. And I do want to note that Andrew did have to leave for a fairly urgent meeting. He did text me. But I want to thank everybody for the good discussion. And again, just like January's, it's difficult because it's hard. And so I appreciate everyone doing this respectfully, or as Lisa said, like adults. So thank you. And everyone should pat themselves on the back for that. This is really hard work at a critical time. So it's hard, but I appreciate how we're doing it. So with that,
Motion to adjourn?
I'll second it.
all those
Not
in
that I
favor?
have dinner tonight, but
Oh, no, I'm with you. All those in favor say aye.
Aye.
Opposed? All
ooh,
right. We
cool,
are adjourned
quarter
at
of. Good job.
5:45.
Oh,
Yeah,
Thanks, everybody.
bye-bye.